How are you, Paul? Everything is fine?
I'm good. All the better for seeing you, Theo, as always.
Perfect. So I was just introducing the Instagram channel to those who are new here and they don't know about the channel yet. Also, ladies and gentlemen, we have the YouTube channel. That's the most important, in my opinion. Please make sure not only you subscribe, but also you enable the notification buttons every time any of the recording webinar Paul does and goes on the trading Spotify, you will get notified. Paul is doing this favor to traders to teach price action like I believe you will not find it anywhere else as accurate. So I'm sure you find a lot of value out of this session. So thank you so much, Paul, for doing this.
You're welcome. My pleasure.
So I think you can share your screen now.
Okay, excellent. I'll just do that. I'm hoping that bang. I'm hoping that everybody can. I'm hoping everybody can hear me. I hope everybody can see the slides. If you could let us know, that'd be fabulous. Thank you for that. Thank you for that introduction, Theo, and welcome everybody to the next in our price action trading guide session, number 23 for target
Sorry,
trading
Paul,
stuff.
We cannot see your slides.
All right. Just bear with me 1 second. They're up there. Just let me just 1 second here. Let's bring this up. Zoom is playing with us, isn't it? Here we go.
Yes.
That's what it is going on there.
Now that's perfect. Okay, Paul.
Excellent. We're in there. There we go. Zoom was trying to trip us up there. Okay, but there you go. Excellent. Thank you, Theo. Thank you for that. Thank you. Welcome, everybody. Great to see you here. And welcome to our next session, session 23, ladies and gentlemen, on our price action trading guide. And today we're going to talk about, our exits. So in previous sessions, we've talked about exits using risk management for when our trade idea doesn't work out for us. But today what we'll talk about is our exits for when our trade does work out for us. Are we going to have a target in place, or are we going to sort of trail our stop? So we will discuss that through our session. Okay, how do we manage rewards? We've looked at risk. How do we look at the other side in terms of managing rewards? So remember, here we are, Admirals, okay, a global broker with local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing you to engage with markets using both the MT4 and MT5 platform. Any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. So, we're going to talk about price action trading as always. I appreciate there'll be some people here just new to trading, new to price action itself. We'll just talk a little bit about that. We'll also mostly focus on, what are the options with managing reward? Why is it so important? What are their pros and cons? And how do we actually utilize them in price action trading? And I'll share an example from one of my own trades, okay, from a couple of weeks ago, and show the difference in the different ways of managing reward and actually how you can utilize that in your own trading. And as always, if there's time at the end, we'll have a little look at the live markets. We'll have maybe a little look at what happened yesterday afternoon in those US indices in terms of understanding and talking about how do we manage reward in that particular instance was on intraday trading indices. So for those of you who don't know me, my name's Paul, and I've traded for many years, traded for funds, traded for clients. Primarily, I like to focus on FX indices and commodities. I tend to be a trend trader for my swing and position trades, and I tend to focus on reversal trades for intraday trading. And I'll be sharing all of that kind of experience with you as we've been going through this particular series. And this particular series is all about helping traders understand and utilize price action in their own trading, because we see it. I see it myself. Is that sometimes traders who are at the start of their journey to be intimidated a little bit by the amount of knowledge that's required and also out there these days in order to be able to analyze and engage with markets. However, with a little bit of education and a little bit of understanding of price action and how candlesticks are formed and what they tell us, well, then it becomes easier to analyze and understand markets. And that's what we're sharing here. So each Wednesday, we will build upon the previous session so that you're educated and informed how to use price action in your own trading. And, there is a huge amount we can cover in terms of price action. There's all sorts of little nuances and elements of it, okay? And I'm going to try and share as much as I possibly can. And what we've been doing is an awful lot of education, but, as what we will do is we'll start to shift more towards, well, what's going on in the market at the moment? What is the price action telling us? How could we trade, all right? How that based upon what we have covered in our session so far. So if you're completely new to trading, all right, and just at the start of your journey, and you might not even understand what price action is, all it is just a basic means of market analysis using price movement over time. It's popular with both retail and institutional traders, and really the action is all about the changes in price over time. What we look to do mostly is focus on price action over the last 3 to 6 months, right? And the reason being for that, as always, as I say, I appreciate that a lot of the people either joining us or watching this later on the Admirals YouTube channel are probably not trading full time. They're probably trading around existing life commitments. Maybe you've got a job, maybe you're running a business, maybe you're managing a family, maybe you're looking after parents. Okay, we have all sorts of lifestyle commitments. And so even though you may want to trade full time, you're unable to. And so what we'll do is we'll look at price action, okay, and we will mostly focus on, let's say, swing and position trades that someone could do with just a little bit of time around, around their, let's say, their existing lifestyle commitments. What I would suggest is that everything I share with you in terms of price action, in terms of setups, in terms of the way to operate is, as we hopefully you're starting to see, it works across all time frames and all instruments. Yes, it may focus or it may work particularly better on one instrument over another or one time frame over another, but as a general rule, okay, price action works across all time frames and all instruments. And so I personally believe that a trader, okay, a new trader, if they can get to understand price action, be able to use it, it is a fantastic base, all right, from which to move forward as a trader. Yes, you may look to hone and focus on particular timescales, particular instruments, but if you can understand price and read it, it's like learning a new language, right? It will open doors for you. It will allow you to go anywhere. And that's the same with understanding price action. So you can see here that we've covered an awful lot so far. We really have covered an awful lot, okay? And as I say every week, we try to focus a little bit on both the hard skills of trading and then also the soft skills. So my definition of the hard skills would be, the setups. Traders love setups, okay? We all love a setup, all right? It's just the way we are. So things like engulfing candles, star formations, key reversals, pin bars, inside bars, false breakouts, okay? And there's plenty of those in there. And remember, all of this is available on the Admirals YouTube channel. So if you missed a piece or you feel like you need to sort of go back, it's all there. Please, avail yourself of it, okay? Because there's plenty of information there. But there's also the soft skills, the soft skills which completely new traders may not necessarily understand the relevance of, but I assure you, the longer you trade, the more you'll realize how important it is to you. So things like preparing for opportunity in markets, managing risk, building a trading plan, having checklists, okay, how to review your trading, using, grading your trade setups. They're all in there. What might, as I said, might be seen as the soft skills of trading, but I assure you, the longer you trade, the more important they will become to you as you develop and evolve into the best version of your trading self. And so today, we're going to talk about targets or trailing stops. How do we go about managing reward? What are the particular options? And it might be interesting to know, for those of you joining us here today, what do you utilize at present? Okay, if you're already trading, what do you utilize in terms of managing rewards? How do you, when a trade works out for you, how do you actually look to sort of, how do you look to exit when your trade is profitable? Is there a particular way you go about it? Is there a particular way you like? It's always great to hear how other traders look to interact with markets. And now, as I said, I'll share you a couple of ideas of what new traders should be doing, okay, and they should be taking on board in terms of how they look to operate. So as always, what we've talked about is having simple routines, those soft skills, all right, which new traders don't recognize the relevance of, but I assure you, having a good routine, okay, we can start with a checklist, becomes a routine, which becomes a habit, all right, and that's what you want to do. You want to develop good habits as a trader. So, we just talked about in terms of price action, okay, whenever you open a chart, whatever it is, gold, Bitcoin, all right, Tesla, I don't care what it is. First thing you do is you draw in your levels of support and resistance. Start your monthly, go down to the weekly, down to the daily, draw them in. Despite what algos might be doing in terms of increasing relevance in markets, people and even trading packages, they still remember particular levels of support and resistance. It's important for us to have them in. We don't want to be buying into resistance. We don't want to be selling them to support, all right, as new traders, all right? So that will help us do that. Step 2, you want to define if there is a trend. I say this every week. Good trends leap off the chart at you. Do not force it, all right? If you're looking at a chart and you're turning your laptop and you're trying to work out and you're squinting your eyes to see if that is a trend, it probably isn't. Good trends leap off the chart at you, okay? So, if you can't make one out, it probably isn't there. Don't force it. Just go elsewhere. Just go and find where there is a trend. And the reason we're interested is because in step 3 is we're interested in how does price react at those particular key support and resistance levels. They may be those horizontal levels of support and resistance we draw in. It might be things like big round psychological numbers. Could even be dynamic support and resistance off moving averages, which we're going to look at the end of this month, okay, in the next couple of weeks. And so be sure to join us for that. Because if there is a trend, what we want to be doing is, in an uptrend, we want to look at opportunities to buy at support. In a downtrend, we want to look at opportunities to sell at resistance. And when we're at those areas, well, then step 4 comes in, is that we're looking for price action triggers. Price action triggers at those areas of interest for us. And, we've covered most of those things like pin bars, engulfing candles, star formations, inside bars, key reversals, plenty of those, okay, that you can use as a trigger. And it's also interesting to know, is it part of a bigger chart pattern? Because that bigger chart pattern might be tradable as well. So maybe, in a trend, it might be a flag pattern. At the end of a trend, maybe it's a head and shoulders pattern or a double top, etc. They're all there, and it's interesting for us to recognize and build them as we start to build our price action trading routines. In terms of instruments, okay, there are an awful lot of instruments here, all of them offered to you, okay, by Admirals on their MT4 and MT5 platform. So in FX worlds, we look at like 28 major pairs plus the dollar index, pretty much all the majors. You could look at more, okay, maybe you're joining us for more, somewhere exotic, somewhere nice and warm and exotic in the world where I'm sat here with snow around me, okay, you might be there and that might be what you want to particularly trade. That's absolutely fine. Price action is fine, but we'll look at focusing, 28, okay, the major currency crossovers. We'll also look at some of the major indices, the American major indices, okay, European indices, and a few of the Asian ones. We'll also include some of those commodities, oil, gold, silver, etc., natural gas, which has been very relevant the last year, all of which are available on the Admirals platforms, and then equities. People always were interested in FANGs, and we'll do that, but we'll also add in 1 or 2 extra ones. And you might have a couple of personal favorite equities that you particularly like to trade. And as always, there are some people who like to trade Bitcoin and other cryptos as well. Price action works across the board. All right, that's the good thing. As I said, it's like learning a new language. If you spend a bit of time, practice every day, soon you'll be able to open a chart of anything and be able to work out how to trade it. And that, as I said, that's a great skill base to have. All right, that will never leave you. All right, it's one of those life skills that that is actually really useful and will stand you in good stead forevermore. So, in terms of what we want to talk about today, as I said, in the past, we have done pieces on risk management. We've covered an awful lot on that, okay? And those of you who know me, those of you who have worked with me, will know I'm hugely keen on risk management, okay? It's the first page, all right, of what any trader needs to be doing. It's the first building block that needs to be in place to understand how to operate effectively. But there is also the flip side of it, all right? There is the flip side. Once you've dealt with risk, then you have to look at the other side of the coin, reward, okay? And how do we quantify our reward, which is where we're looking to take profit? Well, it's our entry price versus our exit price, if we're right, if that trade has worked out, okay, in accordance with our trading plan. Now, the reality is, most traders would love every one of their trades to play out accurately. Everybody does. Everybody loves a winning trade. But the reality is that is not going to be the case. Okay, you're going to have losing trades. Hence why you focus first on risk management. But then on the flip side, okay, you're looking at reward. And you have to think about, well, what are our options? Okay, what are our options? What do we do when a trade is working out for us? What can we actually utilize? How can we make the most of it? Well, first and foremost, it's important for a trader to recognize and understand and manage risk versus reward. Often you'll hear some traders call it the 3R, okay? The 3Rs, risk to reward ratio. And you want to understand and have understand what that is and recognize where your trade plan sits now. What I mean by that is when you've seen your setup, okay, that works for you, how is it working out in terms of your risk versus reward? What we find is, lots of new traders, the trade triggers, the trade starts working out for them. They get a little bit giddy, they get a little bit excited because the trade is working, again, a little bit profitable. And it's a natural human inclination. They want to snatch at that profit. They want to snatch it. They want to grab it because they've worked hard. Okay, they're challenging their trading. They're seeing that their trade is going in the right direction, and they want to grab at that particular profit because they think, that that's the way to operate. But actually, what we need to do is we need to have a little bit of savviness, a little bit of nous about how we understand that flip side of the coin, the reward. In particular, what I talk about is I always talk about having an asymmetric reward to risk ratio. What does that mean? Well, that means, if I'm risking £100 on a trade, I want that trade to have the ability to generate 200, 300, 400, 800, okay? I want to be able to have an asymmetric. I want the reward to be heavily skewed in that favor. And that is one of the ways that, I understand the best way to operate as a trader. It's not about always being right. It's about when I am right, it is about being able to generate as much profit as I can from those winning trades. So, part of that becomes a balancing act in terms of the risk versus the reward. And a lot of that is defined by your own risk profile. And I can teach you an awful lot about trading. Okay, you can go through all these other previous price action sessions and all the other sessions that myself and my colleagues do here on Admirals, and there's plenty of there to educate on. The one thing you have to bring to the party is understanding your own risk profile. And that's the thing that you have to recognize and understand. Some traders, in fact, we all sit on a risk spectrum. Okay, we all sit on a risk spectrum. Some traders, okay, are very aggressive. They're very accepting of risk. Others, they're very cautious. Okay, they're very averse to risk. And we all sit somewhere on that spectrum. And what we want to do is to understand where you sit. All right. The way you do that really is by taking trades, keeping excellent records, and then being able to review those records and start to get a sense of what your own risk profile is. I'll give you a little hint. Generally, lots of people say they are very comfortable with risk. They say that they actually are quite aggressive with risk. But the reality is that actually the reality is quite different. And actually many people are very much more cautious than they think they are. And that's okay. All right, that's okay. There's no necessarily right or wrong. It's about knowing who you are. It's about understanding your risk profile. And it's about trading in line with what your risk tolerances are. Okay, as I said, some people are very aggressive. Some people are very cautious. Most people are more cautious than they think they are when it comes down to it. All right. And as I said, that's okay. You just want to know who you are and be honest with yourself and trade in line with that. If it turns out that you are very cautious and very, averse to risk, but you are trading a style that is very, very aggressive, that the chances are you will struggle. Okay, you will struggle to trade that with discipline over a long period of time because it just doesn't sit right with your risk profile. So understanding it becomes really important, ladies and gentlemen. And as I said, keep great records of your trades, start to review them, and you will start to get an indication of, what your own particular risk profile is and where you sit in terms of, what can help you is to understand a little bit about the relationship, all right, how risk and reward, the relationship between strike rate, okay, your hit rate, how often you are right, okay, your win rate, versus your risk to reward ratio, okay. You might have seen charts like this or similar ones of charts. If we have down here, okay, on this axis, our risk to reward ratio, if you only have a 1-to-1 risk to reward ratio, so for whatever you risk, let's say your trade risk is 50 pips, okay, your trade risk is 50 pips between your entry and your stop loss, and you generate your target, okay, you generate 50 pips, well then you have a 1-to-1, your risk to reward ratio. And not unsurprisingly, if you're only right 20% of the time, 2 times out of 10, well then you're just not going to be profitable. If your risk to reward ratio is 1-to-1, well then you need to have a trading platform or a trading method that has at least a 50% hit rate. Okay, and that's it's very simple sums. Okay, anything above 50%, okay, means you will be profitable. So 60, 70, 80, 90%. That's great. Okay, and that's fabulous. Okay, and if you have a trading method which allows you to be right 60% and above, okay, then you can operate at a 1-to-1 risk to reward ratio. What you will find is, as you're learning, your hit rate is probably going to be less than you want. Everybody's hit rate is less than they want. Okay, welcome to trading. All right, that's the way it is. Okay, so what we can see is, and this is what I was talking about a little bit earlier, is once you start having an asymmetric reward to risk ratio, so you're risking 1 to make 2, risking 1 to make 3, risking 1 to make 4, risking 1 to make 5. It makes a big difference in terms of your strike rate. Okay, so for example, on a 3-to-1 reward to risk ratio, well then anything above 30%, okay, anything above being right 3 times out of 10, well then you start to be profitable. Now that makes a big difference, because that means, if you look at it correct, that means that you only have to be right 3 times out of 10, and you're actually you're on the right side of the balance. Okay, the challenge I find with most traders is that they struggle to be right 3 times out of 10 because they have a need to be right. They want to be right. They want to be right 80% of the time, 90%, 100% of the time. Remember what I was saying earlier about people's risk to reward profile, their profiles. People say that they're comfortable risk, but actually, they want all of their trades to be winning trades, and they want all of their trades to have healthy reward to risk ratio. Everybody wants that. The reality is you have to work towards honing your way to do that correctly. So, as I said, my view is that you should always be aiming for a good, reward to risk ratio. Okay, 3-to-1, 4-to-1, 5-to-1, 2-to-1 and above, because what it means you don't have to be right often. You haven't got that. There's not that pressure on your shoulders to be right every single time. Okay, because that pressure will skew your trading decisions. Okay, make it easy for you to win. Make it easy for you to win. If you have a 5-to-1 reward to risk ratio, anything above, all right, being right 2 times out of 10, it means you're profitable. Okay, anything above that. That is how, when you read about people like Paul Tudor Jones, George Soros, etc. I think George Soros has like a 10% win rate. All right, but he has done very, very well for himself. Okay, down the years. Paul Tudor Jones, he talks, he makes commentaries about, finding a method that generates 5-to-1 risk to reward and be happy with like 20% of the time being right. And and he once again has done very well for himself. Okay, so there's something in there that you can take from that, okay, compared to the natural human behavior, which is that you want to be right on every trade. The reality is markets are fluid, they're dynamic, okay, they change. The likelihood of being right every time in a trade is it's not going to happen. Okay, and it's about, as I said, it's about finding your risk profile, about where you are particularly comfortable, and how you build that into your trading plan. So, with that in mind, how do we actually manage our trades and exit our trades when the trade is working out in our favor? If you boil it down to it, there's kind of 2 ways you can do it. You're either going to have a target that you're aiming for on your particular trade that you can work, or you're going to have a trailing stop. this is where your stop loss, you trail it and change it after the trade, and it goes from being a trailing stop loss to being a trailing stop profit as that trade moves in your direction. So there's variations of themes, there's little bits of differences, but really that's what you're doing. You're either doing a target or you're doing a trailing stop. Ultimately, that's what you're doing. Now, targets, okay. Some people would have their benefits as that gives you an element of certainty, okay, as in once it's on their platform, it allows you to be hands off. Once you know you've got your entry set, okay, you've got your stop loss and you've got your target, you have that kind of certainty, which means that you're burning up less psychological capital. All right, people forget that it's not just financial capital you put at risk, but also your emotional and psychological capital. There's also less opportunity for you to interfere. All right. And for many traders, that's actually the best thing they can do for them, because their ego will be wanting them to interfere. They'll be wanting them to change the trades, to snatch at those profits. For many people, that means it's also easier to follow, because you can just fire and forget your trade. Your trade is on, your stop loss is in place, your profit target is in place, and you're almost just firing and forget. Okay. And if you get called away or something happens or something changes, that trade can be left to basically to play itself out. So those are some of the benefits, that you have with just using a target for your trade. So on the flip side of that, if you're going to have a trailing stop, well, then some of the benefits are that it may allow you the opportunity to stay with that trade longer. So you are effectively, you're able to harvest a greater haul, okay? If that trade takes off in a particularly great trend, that allows you the opportunity to run with it, okay? And as I said, that might generate the possible opportunity of possibly higher profits for you in that trade. Some traders also feel that it gives them an element of control, okay? Because you have to constantly check on your trade, you constantly have to work out when is your stop going to be moved and where is it being moved to. That gives them that locus of control to work with. And which means that for some traders, that means it's easier to follow because they feel like they're engaged. It feels like they are active in their particular trading. So that is, that's why some people prefer to utilize a trailing stop, because they think there's the opportunity to stay in the trade longer and generate possibly higher profits. So with that in mind, we'll get into it in a moment. Firstly, you have to look at where you're utilizing protective stop losses. There are lots and lots of different types, okay? Lots of different types you can utilize. There's just a couple here that were mentioned. I'm just reminding them from when we talked about in risk management, because if you're going to have a trading stop, you need to have your stop loss somewhere. Some people might use like just a simple trend line, all right, and then invariably just trail their stop loss behind the trend line. And as the price moves in that direction, so will the stop loss. A variation of that is people sometimes utilizing, a moving average. Okay, there's the 20, there's the 50, there's the 200, and people will actually have their stop loss behind a moving average, and then invariably just trail it behind the moving average when a trade is in a downtrend, and then invariably they close it once price has rallied and closed the other side, back the other side of that moving average. So utilizing a trend line as a stop or a moving average, there are variations on a theme, but it allows some people to have the initial stop and then to trail that as the trade goes in their direction. We talked about how some people, in terms of their initial protective stop loss, they may utilize something like the ATR, so they may have the ATR, the average true range, people can use it on the daily, or you can use it whatever time frame you're utilizing it. So they might identify their entry, and then basically what they might have is, in that particular example, is they use the ATR indicator, to identify what the particular number is for that, what the average true range is for that time period, and then they would basically, in that case, double that, all right, and that becomes their initial stop loss. But then they want to look at, well, how do I trail that? So some people, if they're utilizing, let's say a 2 ATR, every time the price moves to ATR, then invariably that is actually how they would trail their stop loss. So let's say, in that particular case, the ATR is 20 pips, let's say, for want of a word. Every time the trade moves 20 pips in your direction, your stop moves 20 pips as well, So that is something that can be something that can be programmed. It's something that can basically be done hands off, all right? Or it becomes quite easy to monitor in terms of being able to recognize how you just effectively just move your stop loss every time that it moves, whatever your variation of an ATR for stop loss. Some people will use 2, some people use 3, some people use 1.5. Whatever whatever your particular risk profile is. And then also in terms of just having a trailing, in terms of having a trailing stop, okay. So David, looking at 26 there. No, I would normally sort of, when ATR, I'm normally happy with about 10. All right, 10 for the ATR. When you look at ATR and using this, it's not a, it's not a huge leap, all right, between the ATR periods. Okay, it's something that what can I utilize on a a consistent basis. So if you're using like a daily chart, all right, okay, 10 period is fine, because that's normally like the last 10 trading days, the last couple of weeks, and that's enough. And thank you, Darshan. Yeah, hello, Lord Wallace. Nice to see you here as well. Okay, and hope that helps, David. So you can also utilize some of the tools and indicators that are on the Admirals MetaTrader platform. So this is one of them, is called PSAR, all right, a parabolic support and resistance indicator, which will give you the opportunity to effectively, it will set the initial stop for you, all right. So let's just say this is Tesla on a 4-hour chart in an uptrend. Let's say, just for want of this, that we're buying this particular breakout here. And as you can see, there's a dot placed behind beneath the price on its way up, and invariably that's where you'd basically place your initial stop, and then every time it moved, you would move your stop loss with it. Okay, and in that particular case, you can see that it was trending quite strongly until it flipped. Okay, until it flipped, and your stop loss is there until it flips. So what you're able to do is just to follow that, okay, until you're taken out and the PSAR flips. So PSAR is not perfect, but nothing is when it comes to it. Nothing is. What's more important is, can I have a way or a method that I can consistently follow it, trade after trade, for 20 trades, 50 trades, 100 trades, 200 trades? What can I consistently execute? That is much more important than trying to find the perfect stop loss, because you never will find the perfect stop loss. All right, or even trading stop, you will never find the perfect. Okay, there is no such thing as perfection. It's about how can I manage this, okay, on a day-to-day, trade-by-trade basis. One of my longest and best trading buddies, who's a really aggressive intraday trader on the ES and the oil, he uses PSAR himself, because actually it's not perfect, as he says, but what it is that when things are happening really fast, it's just one less thing that he doesn't have to worry about. Okay? He doesn't want that decision fatigue, because he does it. He said it's not perfect, but it's good enough for him, and that's fine. And that's what it is. As I said, there's no perfection. It's about what can I follow easily. Okay, what can I commit to trading with discipline, to having flawless execution on it, trade after trade after trade. That's much more important to you. So, as I said, PSAR there, it's on the platform. If we get time, I'll have a little look and a check of it. So when it comes to managing reward, which one is best? Is it a target or is it a trading? What I always say is that my background was in the Air Force. Okay, Air Force guys, we love to hit a target. All right, whether it's another aircraft in the air, okay, or a target on the ground, we love to hit a target, and I'm no different. Okay, I love to hit a target in whatever way, form I do, and so most of my trading, you'll find, uses a target. Okay. Does that mean that that's the way you should do it? Does that mean that's the perfection? No, as I was just saying, there is no perfection. It is about what can you do consistently after trade 1, after trade 20, after trade 50, after trade 100. That is more important. And I just basically, I like targets. That means that sometimes, I might be out on a trade and then the trade just continues to go and go and go and go. That's the downside. All right, that's the downside. There is no perfection. You just have to basically get on with what you have to trade. So listen, here's an example. All right, here's an example. This is the pound against the Australian dollar on the 4-hour chart here. Okay, just from a couple of weeks ago from a trade of mine. And what had actually happened is, price had basically been getting squeezed between the moving averages. The price action is coiling up, is coiling up, is coiling up. It looks like it's sort of going down to the base, and then basically what we get is bosh. We get a big strong move there, okay, as you can see. And then what happens is price pulls back. Remember what I was saying is that, A, we want to see if there is a trend. Step three is we want to see, how does price react at key support and resistance levels? And what happens is price comes back here towards the 20-period moving average. And then what does it do? It prints a pin bar. Not only is that a pin bar, which is step 4, which is a price action trigger, but also at that time, okay, that is also printing a flag pattern, isn't it? Okay, we've got to move on. We've got a flag pattern. Okay, that is a continuation pattern. So, we're looking to be to trade on. I'm looking to buy the pound against the Australian dollar. That's what I'm looking at. Okay, that's what I want to be doing. So that's the trade setup, okay, and how that particularly works, okay. Raquel asks, have you ever used TP1, TP2, etc.? If yes, how do you set it to TP1? Okay, good question. If you don't mind, we'll just come to that in a moment, Raquel. But I'm very happy to talk about that. If I look at this again, well, as I said, I like to hit a target, okay? I like to hit a target. And I've talked in the past about using a thing called consistent targeting. And this is just using the fib tool here, where invariably what we had was, I'm just drawing my fib tool over there. I have an aggressive entry, okay, for my trade. I'm looking at what my trade entry was, 176.43. My stop loss was beneath the low. Okay, so the low of the candle I think was about 176.01. I think I put my stop at 175.95. Okay, just beneath the candle, beneath the big round number at 176. So that gave me 48. That gave me 48 pips of trade risk. And what I was looking for was, because this was a trend, because at that particular time sterling was strong and Aussie was weak, and I was trading with that bigger trend, that was where my particular target was. And I had what I called a 423 fib extension of the price action candle, which to my target was at 178.80. And you can see for yourself, the price triggered and it fell back a bit, and that's when lots of people get a little bit worried and think that's going to be losing trade. But then basically we created our way up, and we hit my target, okay. And actually in this case, price actually went all the way up. All right, it went much further. It went about another 130, another 140 pips beyond where my target was. Okay, it went all the way up to the big round number at 180. In hindsight, probably shouldn't have been surprised at that. It's a big magnet, big number, price gets drawn to it. But what I'm allowed to do is to basically to fire and forget on my trades, okay? To fire and forget. And that was, just utilizing a simple target for me. Now, Raquel asked about TP1s, TP2s, and that's about taking, what you would talk about is like taking partial profits on your trades. So, do I suggest people do that? Do I do it? Generally, I don't do it as a general rule. I tend to be an all-in, all-out kind of guy. And if anything, I'm tending to look for ways to add to my trades, okay, rather than taking partials. Well, I will admit at the start of my trading career, I did take partials on my trades, and I don't think it's necessarily a bad thing, because what I recognize is that, when you're starting off in your trading career, what you're looking at is, you and what's not talked about is, you can talk about the technicals of it, but it's also about managing yourself. It's also about managing your self-confidence and your self-belief. And taking partial profits as you go, it is a way to pay yourself as the trade goes in your way. And I can understand, and I can remember it myself, is that, gives you a little bit of a sense of relief, okay, when the trade has hit its first, top profit target, you've taken a little bit off, which means you've also reduced your risk, and that can help you, okay, and that can help you if you allow yourself the remainder of the trade to run to TP2, TP3, and have a good distance for that. So I can understand that as a way of managing yourself, managing self-belief, managing self-confidence. You can do that. Generally, what I still suggest is, if you're going to take profits, okay, if you're going to have partial take profits, it should really be at least 1-to-1. All right, it should at least be 1-to-1, if not even more. One of my clients, she does partial profits, but she doesn't take partial profits until the trade's gone at least 3-to-1 in her favor. All right, at least 3-to-1 in her favor. Okay, and then and only then will she take some partials, because even if the trade reverses, it is still a profitable trade. What I find some people do is, they might have an entry, they might have a stop loss 50 pips away, let's say. Their target is 200 pips away. Okay, so they've got what they think is like a 4-to-1 reward to risk trade, which is all very nice, but the trade goes 10 pips in their direction and they're starting to take partials. That's not really helping. Okay, I'd say at least be 1-to-1. Okay, at least 1-to-1. All right, before you take any kind of partials. All right, in a general, and have an acceptance. Okay, if you take partials, that will have a detrimental effect on your overall profitability longer term. So at the start of your trading career, absolutely build your belief, build your confidence, build your trust in yourself, but just recognize that actually as you grow and evolve as a trader, that taking partials is something that basically will have an impact on your overall profitability. So I hope that answers your question there, Raquel. Good question. Thank you. Really very good there. I hope that helps. As I said, this was me on using targets on this. Okay. And I remember looking at that. So it generated 237 pips. Okay. For 48 pips risk. Okay. So, it was getting close towards, it was about 4.5 reward to risk. Okay. On that trade. That's, you take that trade every day of the week. All right. Okay. Take that trade every day of the week. But maybe you'd have taken that trade, but then you'd have wanted to use a trailing stop. All right. And a very simple trailing stop is one whereby you trail your stop loss behind swing points every time in an uptrend, every time your trade makes a move to new highs. So in this particular case, right, if you'd have wanted this, it's the same trade, okay, it's the same setup, you could have had the same entries, right? But here, okay, when the trade triggers and it makes a new high, you'd move your stop, but there's nowhere to move your stop to. But this candle here, when it makes a move to new highs, this becomes the swing point. There, your stop moves from beneath there to beneath there. When price starts making, new highs here, there's nowhere for you to move it. But actually, as price starts to make new highs, you're basically trailing your stop behind, okay, the last swing point. And that's what happens here. Now, some people would have probably taken their profit at the big round number 180. Other people would have just wanted to just run as far as they can. And actually what happens is we get up there and we come back and actually get taken out here. And I think a trailing stop, you'd have been taken out about 78.60 just using trailing on the swings, okay, every time price makes a new particular high. So that is one variation of a trailing stop, and it's quite simple. Every time price makes a new high, you can trail the stop beneath the last low swing point. But there might be some times, just clear off, like once you've moved it here, well then, actually, you've got a few days there before it makes new highs, okay, before it makes actually even a new swing point that you can trail your stop behind. So you have the opportunity that the price is going to move away, but if you're going to trail in a trend, that's what you need to do to give yourself the chance to get those trades where it does actually run and run and run. So, in no particular, because that was a great trade, great trend, okay, great breakout and move, either way would have created a handsome reward to risk on your trades, okay, and which is what you're looking to do. Remember what I was saying, we want asymmetric reward to risk on our trades. That's what we are particularly looking for, okay, and that's what we want to do. And it's about finding a way, what can I do, okay, what can I do that I can commit to executing trade after trade after trade, because that's what we're interested in. So What we are talking about, okay, is that the important thing, what I say to people is decide on your approach before the trade is even placed. What I don't want to see traders doing is start off with a trailing stop and then think, oh, well, actually it's moving, and I'm going to put a target in place now. Okay, that's not the way you should operate. Okay, don't try and switch horses halfway during a race. Okay, that never ends well. Decide on your approach before the trade is even placed, and don't change it trade by trade. What I say is, do yourself, commit to one for like 20 trades, take the data from it and see how you get on. Okay, see which one can you follow it, does it help you, and work that way. Okay, so as I said, in terms of target, make sure you've got a positive targeting idea, like 2 to 1 and above. Do that so you've got that asymmetric reward to risk ratio. And trading, make sure you have a suitable trading strategy, a suitable trading method. Maybe it is just trading behind swing points on the way up. Maybe it's something even simpler, like just a 3-bar trading stop. Maybe you're just utilizing the PSAR tool that is on the platform. Okay, like my friend Big Ian and Big Ian, the oil trader in Dublin. Okay, you can do whatever it is. It has to be something simple that you can follow trade after trade after trade after trade. So, in conclusion, ladies and gentlemen, right, price action we know is a way of analysing markets just using the pure price action, and when looking for price action triggers at significant price levels of prices or zones, and allows us to build simple price action trading plans, regardless of whatever you choose. All right, okay, plan your trade your plan. All right. Don't let your reward be decided when the trade is open, right? Because you will basically make poor decisions, okay? Because you'll just effectively you'll want to grab at profits. Have a plan in place before the trade is triggered. Don't change tracks once the trade is up and running. Okay, have a plan, stick with it. Find something that's easy for you to consistently repeat. That is the key. And think about samples of trades, okay, rather than the outcome of just one individual trade. So we'll just we've got a couple of minutes. We'll just quickly look at the chart. But beforehand, just remember that our next session, okay, is Wednesday, 15th of March. So I hope you'll join us there for the next one. And what we're going to talk about in that section is trading price action on indices. So a lot of work on FX. We spoke about price action on commodities, okay, a few weeks back, and that's on the YouTube channel. But you can also look at trading price action on indices, and that's what we'll focus on in the next section. So we'll talk about what indices are offered by Admirals, how can you best use price action there, what do traders need to be aware of. So that's London, 2 p.m. next Wednesday, 15th of March. Check your inbox for the webinar link or head over to the site and sign up. As always, you can contact Admiral Markets there, okay, if you've got comments or thoughts. After this session, there will be a feedback form. If you take a moment to fill it in, we'd really appreciate that. Anything that helps, okay, because we want to make these sessions useful to you as possible, so any commentary is always helpful. So, as I said, we're overrunning a little bit, but just for a minute or two, we'll just have a quick look, okay, at a chart there, okay, just to have a little bit of a look. And so just bear with me one moment. What we'll do is I'll just switch across to the charts here, okay? So just is that the one we want? I wonder. Nope, maybe not. Maybe not. Right, let's do this. Okay, so actually what we're going to do is we're going to have a little look at the US indices from yesterday. Why? A couple of reasons. Let's have a look at bang, 30-minute chart here. This is the Dow Jones from yesterday. Mr. Powell spoke, price collapsed. Okay, we've been in great uptrends just running it. We peaked out here the day before, okay, and then Mr. Powell speaks yesterday, and bosh, you can see for yourself that is what happened. But as a sort of shorter time frame trader, you can look at that. That was a trending down an intraday basis, and there will have been lots of traders who effectively would have, every time there's a pullback, okay, every time there's a pullback, all right, to remember what I was saying, that even we focus on higher time frames, the same principles occur, okay, that in a downtrend we want to be basically selling at resistance, okay. So when it makes very clear sells at resistance, that's what you're particularly looking for. And you can do that, and you can effectively, I have fractals on here, but you can sort of trail behind those if you're a particular somebody who likes to trail, or if you're completely new, as I said, you can utilize PSAR here. Okay, we'll just on the different, there we go, parabolic, there we go, bang. So I'm just going to, yeah, I'm just going to put that might be a bit, the colours might not necessarily have been a great choice of colours there. Maybe we'll change that, Paul. Maybe we'll just make them a little bit bigger for you as well. But there you go. So hopefully you can see that, you know, for those who trade breakouts, okay, you can see where the PSAR was above, and invariably that would have kept you in for a good part of that downtrend until it flipped, okay, but then it comes back in and it sets up again and falls away there as well. So as I said, something like PSAR, if you're going to use a trading stop, it isn't perfect. Nothing is, but, you know, it is a simple way for you to be able to do it. And the important thing is choose before your trade goes on. You know, am I utilizing a target or am I utilizing a trading stop? That is what's that's what's key for us. Okay, there, ladies and gentlemen. Unfortunately, time flies when you're having fun. I just noticed my thing there's reversed itself there. Time flies when you're having fun. Unfortunately, we've run out of time. I hope that you found that useful. I hope that's given you a little bit of insight into the other side of the trade. Okay, what happens when the trade goes well for you, and what you need to do to manage your reward, either using a target or using a trailing stop, which becomes your stop loss, which comes into your profit stop. Okay. Remember what I said, just choose one before the trade starts. All right, look at not the outcome of one trade, but samples of 20, 50, 60, etc., 100 trades. That's actually what's more important to us. And as I said, trade well, everybody, and I hope you'll join us next week when we talk about trading price action on indices. Have a great trading week, everybody, and I will speak to you soon. Many thanks. Cheers.